Unfortunately, Pravi can't make it today, so it's only going to be 4 of us.
Yeah.
It was so interesting. I was just sitting over there. I was listening to some other panels. They were not their topics were not digital assets, but all of them were talking about crypto. So I guess we do have enough reasons to be here today. Could you start by giving us a brief introduction of yourself and what you do at your company?
Yeah, I can go first. My name is Paul VERADITTAKIT. I'm a partner at Pantera Capital. Pantera Capital is one of the earliest institutional investors in crypto. We launched from Dan Moorhead, who used to be CFO, head of global macro trading and Tiger Management. We do everything from allowing people to buy Bitcoin through us, through our Bitcoin fund, to also doing venture capital and investing into tokens, early stage and late stage. We manage about $5 billion, and I handle private investments at Pantera. I've been doing it for the last 8 years.
That's super cool. Rob?
I'm Robert Materazzi. Excuse me. I'm the CEO at Lukka. And Lukka, we service companies like Pantera with our software and data solutions that are specifically tailored for the intricacies of crypto transaction data.
Adil?
Hi, I'm Adil Abdulali. I'm CIO of Securitize Capital. Securitize is a tokenization platform that takes private assets like private equity funds, hedge funds, real estate, whatever, and makes them into tokens that can be traded on Ethereum, on Algorand, Avalanche, and such other chains. Now, Securitize Capital as a subsidiary works with issuers and comes up with our own funds so that they can effectively have a way of smaller and nimble investors coming into actively managed crypto funds and private funds that otherwise they would not be able to invest in. And later on, I'll give you an explanation of what's the difference between a security token and an actual kind of crypto token like ETH or Bitcoin.
Thank you all. We are in a bear market right now. Bitcoin is down more than 70% from its all-time high in November, and some other tokens fell even more. Tell us more about how you guys are navigating this bear market. We'll start with Paul.
Yeah, so we do feel that we are getting close to the bottom, or we hope that we're getting close to the bottom. It seems that way. It's pretty low right now in terms of Bitcoin being under 20,000 and Ethereum even touching under 1,000. I mean, I think for us, a couple of different ways that we're navigating this bear market. We actually feel like for our portfolio companies, it's a great time to be building. And so a lot of talent has come in, and we'll talk about previous bear markets, but a lot of talent has come in. And so we believe that it's our duty to help out our portfolio companies during this time, educate them on what they should be sort of focused on in the bear market. And one of the things to be focused on during a bear market is really building in terms of actually hiring. So you're seeing a lot of larger companies, TradFi companies or institutions and other larger crypto companies and other even tech companies are laying off. So it's a great time to be acquiring talent right now. Pantera is also doing the same thing. We're actually hiring on the investment team and the platform team. And being able to actually have time to train your employees and train them in terms of the culture, the process. I mean, that's one thing that I think is pretty big during this bear market, is really just kind of building out your product, building out your team. And then I think for us, just being, I'd say just moving assets around in terms of just being able to have time to kind of figure out like which liquids you should be in right now. But a lot of it is really just making sure that our companies have the runway and the right strategy to sort of succeed going forward. And then in terms of the investment side of things, I mean, we're really trying to focus on areas that we think are going to be good during the next 12 to 18 months. So maybe companies that are targeting more of a B2B model, or companies that will sort of provide infrastructure. I think those are the types of companies that we think are going to be built and have maybe more sustainability during a bear market.
You said we're close to the bottom. Where do you see that bottom is?
I don't actually think there is a price level for the bottom. I really think it depends a bit more this time around on macro and really what the Fed does. So I think once the Fed actually changes some of its trajectory, then I think that's when we'll hit the bottom.
Thank you. We'll go to Rob. How are you guys navigating this bear market?
So kind of the point that was just made around building and refining operations. I mean, that's what our business provides customers. So for us, financial reporting, tax filing, audits, all of those still continue regardless of market conditions. Maybe some negotiations get more challenging. We've had a couple customers that are in more extreme situations, of course, but I'd say they're pretty few, and we have a lot that are reaching out to us for the first time because they are focusing on operations and then are finally ready, because using our services does take some time to get you set up, kind of like using any technology for the first time, whether it's NetSuite or Salesforce or and so on. And so we're helping our customers with those. We're trying to offer our support, whether it's with a revised tax strategy or some other type of strategy on top of their data. So I'd say that's maybe how it's different than traditionally, when we're in a bull market.
For sure. What about Adil?
Well, my view is it might be a bear market in prices, but it's a big bull market in the underlying technology. And if I explain to you the differences between kind of what a security token is, which is our business, versus Ethereum or Bitcoin or some of these other network-oriented tokens, you'll see what I mean. So what is the difference between a security token and sort of Bitcoin or Ethereum or one of those traditional layer 1 tokens? The layer 1 tokens are really a motivation structure for organizing human beings into a large group. So it's a network. The token incentivizes the people who run the network nodes and keep it up and running, run the computers that are necessary, and they get paid in the token of the network to incentivize them to keep doing that thing, otherwise they wouldn't do it. The other purpose of it is to actually charge for the network usage, because if you didn't charge for the network's usage, there would be too much traffic and it would get congested and it wouldn't be able to run properly. So those are functions of a token that allows this network to take place and record transactions, whatever those transactions may be. Now, flip to what a security token is. A security token is just an entrance on one of these blockchains. So it's just a record-keeping device of who owns the stock of a company. So if you have a company and you issue shares, you could do it in the OTC markets like GBTC does as a fund company, or you could issue a security token that records who owns the shares on a blockchain like Ethereum. And in order to become a security token, there's a lot of technology behind it, and that's why I say it's a bull market in the technology, because if you own a stock in the United States, it has to be recorded on a regulated transfer agent, and a transfer agent regulated by the SEC. So naively in 2017, when we said, oh, let's tokenize our fund, well, first you have to become a regulated transfer agent for digital asset securities. That takes a whole bunch of time to get through the regulations. Then to issue the security, instead of an ICO, you want it to be legal, you have to become a broker-dealer under FINRA. So that's why securities markets came about. Then to be able to secondary trade those tokens, you have to be an ATS, an alternative trading system, also regulated by all kinds of people. You have to get a license for that under Reg NMS from the SEC. And then finally, you want to have some way to onboard people to the KYC AML that's also required by all kinds of regulations. So you have to have like a Securitized ID or something like that that does all that paperwork in the beginning. But once you have that technology in place, now you can tokenize anything and have it trade in the secondary market. And so all the technology is being built, more is being built and put on different types of chains, and now we're trying to put more assets on it so that people can interact with securities in this new way rather than the old DTC and SWIFT way. Sorry, a little long-winded, but...
That is definitely very interesting. This is definitely not the first bear market for crypto. And every time during the bear market, people say, oh, cryptos are going to die. But today we're here. So compared with the previous cycles, how do you see this bear market different? We'll start with Paul.
Yeah, I mean, I feel like, I've seen quite a few bear markets now. I joined the space in April 2014, so probably one of the first institutional investors looking at this. And I mean, the last bull market was 2017-ish, and the bear market that happened afterwards. I mean, it was great. I mean, actually, if you look at the fund that we raised in 2018 and deployed, I mean, it's probably going to be one of the best performing funds that we've had from a multiple perspective. And it's because there were entrepreneurs that got excited about what was going on in 2017, at least in terms of just, some of the trials of the innovation out there, things around scalability, some of the interesting applications that were tried in 2017, got those entrepreneurs excited to come in, and these entrepreneurs had great backgrounds. These entrepreneurs were mission-driven, passionate, willing to sort of build during a bear market. And one of those companies is 𝐏𝐀𝐍𝐄𝐋. We actually found them as they were entering the market in late 2017, early 2018. They built through the bear market, and now, $10.2 billion company, and we led the Series A. I mean, it's like those types of companies that are going to be built during the bear market. But I think this market is different in the fact that, like, during the last bull market, I've never seen as many amazing entrepreneurs enter the space, like way more than like even during the last bull market. And so I think that there's going to be a lot more winners that come out of this bear market, building a lot of infrastructure like 𝐏𝐀𝐍𝐄𝐋 and like Lukka too. But I think we're going to just see a lot more infrastructure that's focused on use cases, a lot more consumer use cases that we hadn't seen before. Things around NFTs, things around DeFi didn't even exist during the last bear market. And so we're going to see a lot more infrastructure that's going to be moving towards like gaming. That's another one too. And we're also going to see a lot more global infrastructure. So I think I'm really excited about investing into non-domestic companies, Latin America, Southeast Asia, East Asia, and we're going to see a lot of the same infrastructure that exists domestically exists internationally at much better prices too. So that's the big difference, is that like the last bull market was bigger than ever. More talent has come into this industry, and more talent is continuing to come into this industry. And I think the last thing that is different too is the capital that's come in has been more institutional during this last bull market versus the last bull market. So there's going to be a lot more capital funding these companies, which I think is amazing. So many new crypto funds, so many existing traditional institutions investing into this space, and also traditional VCs are getting in too.
For sure. Rob, any thoughts on this?
Sure. I mean, I think anyone that is new to crypto within the last 18 months is probably a little nervous right now. I think anyone that's been here before is just looking for opportunities, and their strategy is changing, but they're not nervous at all. I mean, I know that's how we're looking at it. There's a ton of very large businesses that weren't in crypto until about 18 months ago. And the big banks, big financial institutions, and they don't build or launch any business in less than a year. It takes longer than that. So they've all started, and we're not seeing any of them stop now because of these conditions. I mean, they're still full steam ahead. So really looking excited to seeing. I mean, just the companies that we're working with that I can't share yet, but we're very excited about them, and we know there's got to be plenty of other ones that are out there as well that have been doing some very ambitious things. So I think we're going to see some new companies. I mean, clearly lots of consolidation. And any of the funds that raised money that hadn't deployed it yet, I mean, this is perfect for them. So.
Yeah, for sure. Adil, any thoughts on that?
Well, it seems totally different to me this time, the nature of the capital that got created in this last bull market and what came into the space. Because in 2017, it was really the ICO boom. So, you had these tokens floating around, and people raised money in offshore entities. They couldn't even onshore the money. They didn't know how to pay taxes on it. It was like stranded assets all over the place. Banks didn't exist. I mean, if you started an SPV or something, you couldn't even get a bank to bank you. Now, you have banks like Signature, and they have tokenized ways of sending money back and forth. You have wallet providers that are completely safe, like Copper and Fireblocks, that you can literally effectively custody hundreds of coins. When I say custody in quotes, it's not the qualified custodian way, but probably safer than most qualified custodians in traditional assets using MPC technology. So the technology is way better. The capital that's come in from the VCs and investors who understand what's going on is sticky, and it's going to stay around. They've already raised the capital. They're going to spend it on human capital and building more technology. I know we're fairly well capitalized with various series under our belt and lots of other companies like this. So right now, heads down, build technology, and even on the trading side, like on the liquid trading side, there are more exchanges, more infrastructure, Lukka didn't even exist, I think, in the last round. I mean, we use them for pricing through our S&P index products and all of that. I mean, S&P calculates crypto indices, and you can manage funds based on the S&P indices. This is totally different from last time when there was just the crypto degens trading and nobody had any idea what was happening. Yeah, very different.
For sure. Rob, you mentioned there are a lot of institutions that are waiting to deploy their capital. Do you think this bear market is a good time for them to do so?
I don't know if I'd say they were waiting for it. I think if they hadn't deployed it, a lot of them were raising over the last year. And so those that hadn't deployed it yet until these market conditions, I think are without a doubt very happy right now. Where the others that just did it in December, probably a little more nervous. But that's just actually investing in crypto, creating funds, that type of capital. What I mentioned earlier was more just the operational investments that companies are making to actually launch new businesses. That's not slowed down at all. And they're just still moving ahead. I mean, the market conditions maybe affect their pipeline a little bit, but it doesn't change the fact that they've built certain businesses, whether it's custody with a sub-custodian technology provider, or fund administration or brokerage businesses. I mean, we're really selling all different kinds. So,
I just touch on the trading side too, though. I mean, like this bull market, you can actually go out there and buy index funds and get long 30, 40 coins at a time in a liquid fashion. And then, if you wanted to do alpha products, I mean, there are cryptocurrencies hedge funds out there, trading-oriented, arbitrage-oriented, which 3 years ago or 4 years ago, I tried to start a cryptocurrency arbitrage fund of funds or multi-strategy. It was impossible. There were like 2 strategies out there. Everyone did the same thing. Everybody either made money or blew up together. Now there's probably 8 or 10 distinct strategies that you can do that are completely different. A lot of the high frequency traders have come into the space, not for just making markets, but for looking at the microstructure on chain and actually doing fun and intelligent things. So you can put together a portfolio of alpha strategies which have nothing to do with the market going up and down, and you can make, way better returns than what StatArb can make in equities and bonds. So all of these are just a lot more interesting time to invest than before. And yeah, if you missed the beta trade, get on board now. I mean, it's supposed to buy low, sell high. I mean, this is time, and anyway, everyone should be coming in.
Yeah, for sure. So on the venture side, Paul, like when the institutions look at the crypto space, what kind of sectors or what parts in crypto would you recommend them to look at?
Yeah, I mean, right now, we're starting to see a lot of institutional investors coming into our funds, and during the last year or so, I'd say most of them have been really interested in venture. For some of them, like that, they actually, I guess, for those that are, maybe like a little bit more corporate or a little bit more on the financial institution side of things, like they've decided to come in and really go straight for venture. We are starting to see a lot of institutions really just kind of bet on the manager themselves. And that means like wanting to get a diversified bet across all different types of strategies and assets in cryptocurrency. So, our latest fund allows folks to get exposure to not only venture equity, but also tokens, whether they are private or whether they are public. But, what Adil mentioned was that like this is a great time, at least in the public markets and the liquids, to be investing. And so what happened during the last bear market was some of our first institutional investors that came into our funds actually came in our liquid portfolio. They saw an opportunity to sort of buy low and get exposure that way. And so it seems to be hitting the same sort of trend where now that we're getting to what we think is near bottom prices, we're starting to see institutional investors actually just want only liquid portfolio because they feel like, hey, here's an opportunity to really kind of get in where it just seems a little bit more obvious to them versus maybe getting into venture.
That is very interesting. Adil, you mentioned about like securitized tokens. Tell me more about how you see crypto might transform traditional finance, and what's this going to look like maybe in 5 years?
Sure. I just want to touch on one point that Paul said before I move on, which is, this idea of, you asked what sector you should invest in, which coin. And I'd just like to say that, if you had been in the markets in the early 2021, after 2020, and January, February, and you had read every single expert in the space as to what was going to be the biggest thing of the year, there was no mention of NFTs at all, 0 mentions of NFTs. I'm saying that because nobody at this point in the stage of the technology can predict what's going to win. Nobody. So you have to diversify, and venture is the right way, right? Because venture is what it is, lots of little bets. You don't know what's going to work out. Something is going to work out 1000x or whatever, and that'll make up for all your mistakes, which you will make. So that's just the way to do it. So whatever you guys do, you know, buy Bitcoin and Ethereum, and after that, just like buy everything else in small quantities, or invest with a professional fund like Pantera. So now on the security token side, what was your question?
Yeah, could you tell us, like, how do you see crypto might transform traditional finance, and how is it going to look like in 5 years?
Sure. So I'll tell you some of the real alpha type advantages of using a security token versus traditional fund investment. So let's say if you're a hedge fund investor or a private fund investor, if you wanted to, say, redeem a fund and invest in another fund, you would have to give notice, right? You give notice, it's 15 days, 30 days. The fund manager gets your notice. You can only do it quarterly. Then you have to wait till they strike the NAV. There's like a 30-day period when they figure out how much they can pay you. Then they take 30 days to pay you because they can keep it in the bank for that reason. You usually get it, like even though they have to pay you at, let's say, March 31st, the last day of the month, they pay you on March 31st, and the bank doesn't clear the money till like, you know, February 3rd. So you still can't invest till like May 1. So essentially your money is lying around in cash for at least 60 days when you're doing this. Instead, if you take that same fund and if it was a security token like we make on Ethereum or whatever, and if Paul was an investor and I was an investor and I had too much and he had too little, well, over beer, I could just send him my token and that's it. It's done. No cash, no problems whatsoever. So that is pure alpha, because if you think of it like a 20% opportunity that you're investing in, and you have to go into cash for 60 days, that's 300 plus basis points. That type of basis points is the only sort of guaranteed alpha, right? It's no skill involved, it's just operational efficiencies. Same thing with the costs of like administration and all the settlement and all that. The old transfer agent, what was the old transfer agent? When you buy a stock, they actually have paper certificates sitting somewhere in a vault with your name on it. And if I sell it to someone, they cross out the name, put another name, triplicate signature, fax it all here and there. Lots of human beings involved, lots of stuff involved. Here, it's an entry on Ethereum. And you pay some gas fees on Ethereum. And actually, we do it on Polygon and Avalanche and Algorand, which have less fees. And, you know, it's just a smart contract that does the change. It's a little bit of gas, couple dollars, you're done. It's just way better. So that those costs will go back, again, to investors and issuers. That type of alpha is guaranteed because, you know, everybody makes it. There's no skill involved. It's just operational efficiencies. So eventually, maybe it's 5 years, maybe it's 10 years, and I don't know when, because security tokens, the whole concept started in 2017. That's when Securitize, my company, got its first venture funding. And then they thought everything was going to be on the blockchain in about a couple of months. And 5 years later, we just started Securitized Capital, which is an asset management thing, because we have all these great pipes, all this plumbing. We can do all of this thing, and nothing is flowing through the pipes, basically. There's trickles of water. So we need to put things on it, get people comfortable with investing in this way, which is a much better way than through DTC and SWIFT and all of that stuff. The settlement is better, the efficiency is better, the transparency is better. Issuers who issue this way can see what are the wallets that own their capital stock, and when does it change, and who does it change to? They can track all of that. So it's going to be better.
Yeah, that sounds all very exciting. But also, like, over the past few weeks, we saw a strain of negative news in the crypto market. We saw that Terra, one of the largest blockchains, collapse, and we saw Celsius, one of the largest crypto lenders, pause all withdrawals, and Three Arrows, one of the most active hedge funds in the space, also showed some signs of trouble. Rob, what does all this mean for the crypto ecosystem?
I mean, Terra is one of 44,000 spot assets that Lukka supports across its customers. So it's algorithmic. A lot of people had skepticism that it wouldn't be resilient against more stressful scenarios, and that's what happened. I mean, there were plenty of investors that were up well in the green there that had plenty of opportunity to cash out and didn't even when the signs were going down. So I mean, I think very traditional financial risk management is what was needed as it relates to Terra, and I mean, there's plenty of other big companies that are out there that are very material in the ecosystem, and their risk management is being stress tested right now as well. So, but there's where there's one company that's in that situation, I like to believe that there's multiples more that are healthy right now. So
Can I make just a distinction between the Terra Luna situation and the Celsius situation? Because the Terra Luna situation was DeFi, right? And it worked the way capitalism is supposed to work, right? It was a smart contract. It had this protocol. It has $45 billion, $50 billion. Things went wrong. It was liquidated in a few days. Everyone has moved on, taken their losses, done. Celsius, centralized finance, lending platform, LTCM, they've gotten rid of withdrawals. Nobody knows what's going on. It's going to be ages and lawyers and months and whatever. This is the problem with CeFi. That's the old problem. DeFi worked fine. Yeah, bad ideas will come about. Too many people will get excited, but they should shut it down and move on, which is what's happened with Luna. I don't know when it'll happen with Celsius. We're just stuck. I think it's very different.
Yeah, for sure. But also, like in both cases, I guess consumers might be hurt a lot. What's the regulatory implications here, and like, what are your thoughts on this, Paul?
Yeah, I wish Purvi was here for that question. But I guess at the end of the day, whether we're talking about regulations or whether we're talking about just like the maturization of the space, I mean, that is why we're so excited about DeFi. At the end of the day, I mean, we sort of think about it as automated finance, and these DeFi protocols are working the way that they're supposed to work. With CeFi trying to tap into DeFi, I mean, I think that's where the risk is, because there's just not a lot of transparency on what everyone, during a bull market, everything is so great. Everyone's like putting money everywhere and sort of trusting folks that they'll be able to deliver on 8%, 20% yield and whatnot, and people aren't really digging under the hood and figuring out like where is this yield coming from and what sort of risk there is underneath. I mean, you could see right there from the Terra Luna white paper how it works and what sort of risk there is, and we're involved with. We made investment into the token, so we had exposure ourselves too. And we sort of sized our risk, or we just sized our exposure based off of the risk that we saw in Terra Luna. But with BlockFi or Celsius or any of these other centralized platforms, you're not really quite sure what's going on under the hood. And so I think both from an investor's perspective, but also from a regulatory perspective, I think there's going to be a lot more transparency out there, and people are going to sort of de-risk until they understand what's going on and then be able to put risk back on. So I think that's kind of where the industry's moving towards, at least for DeFi yield. For sure. You guys did get out of Luna before, most of that before the crash, right? Yeah, I mean, we put it as sort of a similar thought point as all the other investments. I mean, we size our exposure based off of the risk. We got in early like we do with other investments, and we de-risked over time. So again, we still got hurt, but maybe not as much as some other people. For sure. Yeah, that's very interesting. Do you have anything to add, Adil?
And just on a regulatory question, I mean, I think there are things that need to be regulated. I mean, the U.S. has the deepest capital markets in the world because it has regulations. Everyone trusts it. And even though they're pain to comply with, it actually sort of all works. So when token projects were coming out and essentially raising money to then develop something that looked like a company, those should be securities, and why not? And they should be regulated as such. And I think it's going in that direction. And then projects that are really start out decentralized with a whole bunch of like a DAO type structure where there's no centralized authority, whatever, those should be treated as something else. Those are kind of a new thing. They should be treated as a new thing, and I think that will work just fine. Stable coins that are trying to be US dollars and act like banks should be regulated like banks. That's just the way it is. And if they're not regulated by banks, there will be these algorithmic things which will keep failing, and that's fine too. Let people do that. There's no, let's just be transparent about it, that that's what you're getting into, that you're taking a huge bet of asset A versus asset B, and then let it go the way it goes. Let it come and go. Let creative destruction. That's what capitalism is about.
Rob, do you agree with that?
I do. I think just to add on to it, I mean, the regulators are another layer of risk management. We've all become, and I mean, definitely in the United States, many other countries have become a lot better at financial risk management following the financial crisis. Lots of lessons there. All different types of businesses that were affected, and they were rolling out different forms of regulation for those businesses. I mean, for quite some time following the financial crisis. What was looked at a little bit there was the underlying technology operational risk, and that is a lot more relevant when we're looking at crypto in these companies than maybe some traditional markets. And I think that's what the whole ecosystem is doing very poorly right now. I mean, they're not managing the operational risks associated with all of this. And that includes the regulators. I mean, I don't think they're even looking at it right now. So there's a long way to go. I mean, it's great that they're trying to figure things out. They're going too slowly, for sure. They need to involve more of the industry to actually come up with these solutions instead of trying to do it with scare tactics. And depends on the regulator, of course. A lot of them are very collaborative. Some of them are less. And so it's the same thing. I mean, we're on various subject matter experts from the ecosystem are on panels all the time, and it's the same thing every single time, is education, education, education is what the regulators need. And so I'll say that again. But they also need to move faster, and I think they need to find new ways to collaborate than how they're doing it now in order to finally get to where we need them to be.
Yeah, and I think the last thing I'll add, sentiment from our entrepreneurs are that, like, we want regulation. I mean, it's not something that, like, we don't want, because at the end of the day, like, it's hard to sort of push forward in terms of your strategies and maybe even, like, monetization models unless you have a little bit of clarity. And so the industry is sort of innovating, yet I think it could be innovating a lot quicker, and entrepreneurs actually want a little bit more guidance there. So, you know, I think it's great that there is communication going on between regulators and entrepreneurs and funds now. Hopefully we'll get to a good place, but, you know, the sooner the better.
For sure.
I would say that my confidence and our confidence in regulators doing the right thing is a lot higher now than it was like 2 years ago or even after the last bear market. It was really uncertain back then whether it was even going to be allowed to exist. I mean, there was still talk of like Bitcoin being banned in the US and all of this. It was very, very hairy. And all the investors at that time, the biggest topic on their mind was that the regulatory risk was the highest. Now, yes, there's some regulatory risk, but it's more in the nuance, like what are they going to do? How are they going to do it? There's no talk of banning any of this stuff, right? It's more like nuanced thing. Like, for example, the qualified custodian rule for a registered investment advisor. There is no real proper definition of what a qualified custodian should be in crypto. So they'll work that out. But in the meantime, we're not investing because we can't find qualified custodians. We're already going, and lots of other people are doing it, not just us. They're going about like policies and procedures that, you know, attest to the existence of the assets, attest to the, you know, no commingling of the manager assets and the things. And you come up with all of this stuff and you put those procedures in place. So when the SEC comes in and examines you, you say, listen, I've been doing the best I can according to all of these things, and it should be no problem. And guess what? When the same thing happened in commodities, I don't know, decades ago, there was a time when, you know, the first commodity ETFs were being made. And they were like, there was a problem with physical delivery because, you know, you didn't have a qualified custodian for hog bellies or anything like that, right? There just wasn't a bank that would take hog bellies. So eventually, the people who were doing that took good care about what they should take care of. And then the CFTC came up with a no action letter and everything was fine. So that is our current outlook, that at the moment, people who do the right thing, eventually it'll be okay because we're doing what's supposed to be, protecting clients' assets, making sure they're not commingled, making sure that when you say there's X there, there's actually X there. And if you do all of that, what are they going to object to, right?
Yeah. Those are definitely very interesting thoughts on regulation. I do want to touch on the topic of hiring. As some of you have mentioned, crypto has been hiring a lot of people. The whole industry has been hiring a lot for the past 2 years. Like, it's much faster than those in tech or in traditional finance. But over the past few weeks, we saw some layoff announcements from some major crypto companies. I'd just like to ask all of you, like, if there's any changes in the hiring plans at your company. I will start with Rob.
I mean, we have seen some companies. I mean, at Lukka, we're still hiring. There is nothing indicating that that's going to change for the near term or long term right now. We've been hiring, I'd say, a bit more thoughtfully or carefully, very deliberately as we go, making sure that we're still, even if we're hiring rapidly, that we're doing it for people that we do need, that add value to our business, that they're the right cultural fit. That's huge. And thankfully, because of all these job changes that are going on, particularly from the traditional finance world coming into it, it's been great for us because we've been able to hire some incredible talent. And so I'd say, now we're focused on, we're maybe slowing down recruiting a little bit, just watching, but we're also seeing that the talent pool is opening up. There's a lot more talent out there, a ton of very, very talented people that have just come onto the market. So we're excited about it and plan on taking advantage of it.
For sure. Paul, you mentioned you guys are still hiring, right?
Yeah, for us, I mean, Pantera's hiring, and we feel like there's definitely just been a thought of just trying to be able to process more deals, be able to do a lot more research, and also provide a lot more help to our portfolio companies. So we're open for business. We're still hiring. From a portfolio perspective, and what we tell our entrepreneurs is, if it all starts with your runway. I mean, if you're strapped on your runway, then maybe it doesn't even make sense to be hiring right now. Maybe it actually makes more sense to be laying off people. But if you do have the runway, then be hiring like thoughtfully, like what Rob was mentioning. There's probably things that you should be doing during a bear market and continuing to do everything around like product and engineering, but maybe a little bit less on marketing and things like that. So I think it's just really putting capital into the right places. But this is a great time to be doing that if you are looking for talent, because Coinbase and some of the Bird and some of these larger like crypto companies and tech companies are laying off people. So this is a great time to be trying to get really, really high quality talent. I guess the last thing that I'll mention, kind of goes into my role as an investor. I mean, I think we probably haven't seen, as much bearish thoughts, I guess, from sort of non-crypto folks, and maybe it'll get even worse as we enter maybe a little bit longer of a bear market. But my role becomes more around just, telling the story of crypto for our portfolio companies to actually hire. So for the sort of like more important hires, I'll go in there and talk about my experiences in the bear market, my outlook on the industry, why I'm excited about a certain portfolio company. And that role gets heightened during a bear market because, people can get excited about a company, but they get a little skittish around the industry. And so, having that perspective from one of the largest investors in a certain company goes a long way towards hiring.
That's very interesting. Actually, talking about that, tell us more about how you yourself get into crypto at the first place.
Yeah, my crypto journey started in 2013, actually from some other investors that got in earlier than us. I mean, there are some traditional VC firms that were looking at crypto, and the more that I just thought about it, I read the white paper, went down the rabbit hole, the more I just thought about how finance could get disrupted, something like Bitcoin just made a lot of sense. And similar to what Adil mentioned, like I didn't expect things like NFTs, I didn't expect things to go into gaming or DeFi, but even just from store of wealth, disruption of payments, and just financial freedom just got me really excited. So in 2013/14, I started to look around for something that would give me exposure to this space, and found a great fit at Pantera.
That's a very interesting story. Adil, any hiring changes on your side at Securitize?
No changes, but we sort of have gone through the cycle where we raised a lot of money in the last couple of years, and then we put it to work and hired a whole bunch of people to build out the business. into the end of last year, beginning of this year. And then since then, we've just been sort of steadily looking out for opportunistic hires, and nothing changes for us because we're reasonably well funded, so we have a runway. I'm happy about that because, I mean, if you were living on like income from your business fully, like some of the exchanges, then you have no option but to cut down, which is fine. We're at a different stage of life as a company, so for the moment, it's fine for us. But in the next 2-3 years, I hope most of you will be trading security tokens, and then we'll be fine.
Yeah, for sure. I think there are a lot of talents who are looking at the crypto space, found it very interesting, but also they're a bit hesitant because this is still kind of an early stage. Rob, what would you say to them? Like, what kind of advice?
Sorry, which company? I missed the...
No, I mean, like, there are a lot of talents who are kind of looking at the crypto space, found it interesting, but then it also, they saw all the news about that. What would you say to them?
I mean, we're seeing just endless interest in the crypto industry from talent. I mean, even people that are graduating school for the first time. There's actually courses taught on these topics now, which is exciting. There's we do a lot of military veteran recruiting. There's a ton coming out that know cryptography and a bunch of other skill sets that are very transferable into a lot of these companies dealing with all this technology. And so, honestly, it's not a problem attracting people to the crypto industry at all. It's not something that we even think about. It's rather trying to select from this big pool the right talent that's the right cultural fit, and ones that we're going to retain. I mean, we avoid resumes where people have been at, 6 jobs in the last 5 years and things like that. Really try to look for people that are willing to commit, because it's really hard to train people once they start. Like, you're going to be sacrificing something. I mean, at Lukka, we need a lot of technical acumen, like actually coding and that technical. You need to understand finance, accounting, tax. You need to know crypto, other roles that need to be customer-facing. You mix that all together, it's a pretty rare person. So usually we're sacrificing one of those and hiring, and then trying to build a well-rounded team. And so once we do that, it's just incredibly hurtful when we lose that talent after we've invested in them. So I'd say that's really where our focus is, more on the retention aspect than convincing people to come into crypto.
That makes sense. Adil, do you have anything to add?
Well, I just think that what I see out there is still a lot more excitement in this space than any traditional investment thing, any traditional technology firm. So we have people who are traders at regular shops who do this as a night job until they can make it and leave. So they're basically giving us their intellectual capital for free. We have young people, we have a couple of interns working for us who are working for free, and they're fantastic. And they want to keep working until they can contribute something, and then we might hire them. There are lots of people. We have more people wanting to work with us than we have time to educate and get up to speed. If you had more time, we'd have like hundreds of people working. So that's the constraint, not that people don't want to come in, because they see it, it's exciting, it's different from what they've done before. And remember, this is a place where you can actually earn money without getting a job. I mean, we didn't touch on this, but you can work in crypto without getting hired. You can spin up a node, you can provide something to a network, and you can make money. It is possible, and that excites people. You don't have an employer, but you still make money.
We hire a lot of people a lot of people are self-taught. They've run their own nodes, they've done that. They had, mining or staking or revenue pool participation, all these things, and they've been doing it, and they tend to be great data analysts, product managers, and I think we have 16 interns right now. It could have gone to like 100. I mean, it's crazy the amount of interns that wanted to come. We had to cut it off just so that we make sure that we have the right experience for them. But there's no shortage of talent.
That's one of the reasons why the bear market is very short-lived. Or no matter how long it lasts, the technology is just growing so much larger as it goes on that when it comes out, there'll be that much more stuff to do.
Yeah, I'm sure a lot of people in crypto are driven by their passion. It seems we're running out of time, but thank you so much for joining us today. Thank you so much for the great discussion.
Thank you so much.
Thank you.